Hello everyone, welcome back to Just Invest Today. In today's video, I want to talk about my new investment strategy slash kind of style, because I feel like 2020 up into 2022 taught us so much about investing and kind of what to do in the market. And as you continuously learn new stuff, you're learning from different people, from Warren Buffett to Charlie Munger, Damodaran, to just like so many different investment styles and people. You're just learning a lot. You kind of have to switch your style up, kind of adjust to the new times and just do different things. So I'm coming into my own kind of investment strategy slash style. So I want to name 3 things that I'm doing differently and how I'm going to continue to improve and to learn new things. So guys, I'm on this new investment journey, and I think this style or strategy is going to help me a lot, because I just learned so many things in 2020 to 2022 which I can kind of implement in my new strategy. So the first thing I'm going to start doing, guys, and before I get into the first thing, like this video and subscribe to my channel. I'm providing you guys with so much new content all the time, so like it and subscribe. So the first thing I'm going to talk about is actually selling. Yes, selling. And I feel like 2022 taught us so much, man. As the market crashed 20% plus, we see a lot of these stocks like Carvana, like Snapchat, like Facebook, like Baba, all crashing 70% plus, 80% plus, and it's killing returns in the market. And I know a lot of you guys wanted to sell or should have sold a little bit earlier. So when I'm talking about this point of my new strategy, it kind of hits home in this market, because I knew I had a lot of opportunities to kind of do the right thing. So I bought stocks where I thought the intrinsic value was this much, whatever it was. So say I bought a stock at 150 and I believed the company was worth around 250, 300, and it got to that intrinsic value. And with my old strategy of just never selling, always holding on, blah, blah, blah. No, I ain't doing that anymore, guys. When I reach my intrinsic value of the company that I price and it gets to that mark, I'm selling at least 50% of it. That's what I'm doing from now on. I'm selling 50% of it. Get those returns, because that was your intrinsic value for that company. You hit that mark. Why are you trying to wait on? Like, get your returns quick. Get your money. The next 50%, that's going to be kind of my play money into the company if I still believe the company has a long runway to grow. As long as I capture that intrinsic value that I thought of the company, and if it starts going into more overvalued territory, I can just hold on. I already made that profit what the company was worth. So if it continues to go up 50%, I'm still good, because I still hold a strong portion of my portfolio in it. If it goes down another 50% or 100%, and I still think it has a strong intrinsic value, or I still feel like the intrinsic value is at 200 or 250 and it went back down to 50 or 100, then I can put my money back. That 50% that I sold off, I can put that money back in, right? So that's going to be my strategy moving forward, is that when a stock reaches my intrinsic value that I valued when I put my money in, I'm going to sell at least 50%. Next strategy that I'm using, I'm not doing no more of the at cost basis of like 20%, 15% of your portfolio at cost, 20% right away. No more of that. That is just a bad strategy. That is just you being so brave and brash. Like, how do you know? Even if you're super confident, you believe so much in it, like, are you just sure like that's the company that's going to generate you all the returns? Like, sometimes that you think that that's the company, it's not really. It's going to be like the 4th or 5th company that you own that takes off and does all the returns. So I'm always going to start with maybe a 5% position, a starting position in my high conviction bets. Then if the stock drops like another 50%, that's when I put another 5% in it. So I have a 10% total position in my holdings, which is a very good starting point, instead of having a 20% position right away at cost, and then it drops like another 10, 50%, and then you you're damned. You already put a 20% position. You can't just keep going lower and lower and lower. And that's what I did for Alibaba. And that was a mistake of just putting a lot of my portfolio right away and not waiting and not just kind of testing the waters out. I should have started with a nice 2%, 5% position first, waited for a huge drop. If it didn't drop, then I just had that 5% position. If it drops more, 50%, then I can put my 5%. Now I have a 10% nice portfolio, nice and rounded position of Alibaba or whatever stock that you own. So that's what I'm doing from now on. And that had a lot to do with kind of guy Spier and people like Aswath Damodaran. Like, those guys kind of influence that mentality of, man, you're not always going to be right in investing. Even Peter Lynch, Templeton, those guys influence my thought process when it comes to that. I'm kind of leaning away from Warren Buffett and Charlie Munger when it comes to that because, man, like, you just don't know you're going to be right, and you're new to investing. You don't have 10, 15 years into investing knowing that your picks are going to be the one. Like, we don't have that experience. No one really has that unless you're a top investor. So you thinking that you can just predict that this company that I put 20% my portfolio in is gonna make it out, and that's gonna be the one that's gonna 5x, man, like, that doesn't even seem realistic to me. So that's my strategy moving forward. You gotta humble yourself. You gotta kind of be more open to having more like 10 to 15 positions of 5% bets, 5 to 10% bets, whatever you see fit. That's what I'm gonna start doing moving forward. The third thing, I'm gonna stick to my margin of safety. I don't want to kind of waver from that as much. I'm still gonna buy wonderful companies below intrinsic value, but 50% off, but not exactly buying companies at a fair price. I still want to buy a little bit cheaper than a fair price. Like, I don't want to be too conservative, but I don't want to be too optimistic. So moving forward, the growth rates I'm gonna have for these companies, especially if it's a mature company or if it's a growth company and it's not earning, you still kind of want to be more on the conservative side. Like, when I was valuing companies back in 2020, 2019, I wasn't being too conservative. I was putting higher growth rates into the future, even though the past says the growth has been 10, 15%. Like, are you sure you're projecting out and that's what it's going to be 10, 15% into the future? You got to kind of be more conservative and less confident in that prediction. So right now, I'm thinking just buy more with a margin of safety. Be more conservative. Don't be more brash and optimistic about the projections you're having for these companies that you're buying. So that's my 3 things I'm going to be working on and actually kind of implementing in my new strategy moving forward. So guys, tell me what you think about those 3 new things that I'm doing for my investment strategy. Guys, like this video, subscribe to my channel. I'm always providing you guys with so much new content. Like and subscribe. Peace.